Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. On the program today, Italy prosecutors seek jail sentences for ENI and Shell executives involved in Nigeria case. Foreign investors shun South African gold stocks on virus fears. And Ghana to reissue bonds to bail out cash-strapped money managers. First, the markets. And investor sentiment in Africa were negative at intraday, with South Africa's JSE index shedding 1.15%, while the Nigeria's main index was unchanged. In Egypt, the EGX 30 was lower by 0.85% at 10,468 points. Kenya closed negative on Tuesday. And major markets in the Gulf region were mixed at intraday. In the UAE, Dubai's main index lost 1.11%, weighed down by a 2% slide in its largest lender, Emirates MBD, while the Abu Dhabi index edged up 0.13%, supported by a 0.6% gain in Emirates Telecommunications Group. Elsewhere in the region, the Qatari index lost 0.11%, while Saudi's main index added 0.11%. In Europe, stocks retreated this morning as concerns over the coronavirus outweighed optimism over the European Union's recovery fund. Let's get details from Chelsea. Hello, Chelsea. Good afternoon. While the European stocks are broadly weaker after Tuesday's rally drove indices to 4-month highs, are investors already looking past the EU's historic agreement on a 750 billion coronavirus relief fund?
Well, the market does move on from events like this pretty quickly. So it does seem that after months and months of buildup to this decision, now that we actually have the decision, investors are refocusing really on the coronavirus outbreak, but also really in focus today is this continued escalation and tensions between the U.S. and China. Over the past 24 hours, there have been a number of fights breaking out between the two countries. Yesterday, there was an indictment from the Justice Department in the United States over what it's alleging is Chinese spying and attempting to steal vaccine information from U.S. companies. Today, we saw the U.S. order the closure of the Houston-based Chinese embassy. Now China is threatening to retaliate. So there is certainly a lot of tension and a lot of risks coming back into the forefront in this relationship between the U.S. and China. For investors, this is becoming something they obviously need to be pricing into their strategies. The U.S. and China are the two largest economies in the world. The conflicts between these two countries often do spill over into the global economy. We saw this in the trade war over the past several years that impacted not just the U.S. and China, but really every country because of how integrated these economies have become. So this is certainly coming back into investors' mind, and it's certainly a big worry. We did see the DAX fall about 0.5%, but really a lot of the losses were in the Asian session. We saw the Hong Kong index fall more than 2%. So definitely a lot of concern about that today.
Now, airlines in the U.S. and Europe are pressing for an international agreement on coronavirus testing that would allow further reopening of travel. What's being proposed?
So this proposal is coming from 4 different airlines. Lufthansa here in Germany, AIG, which is the parent of British Airways, United Airlines, and American Airlines are all coming together and asking both the U.S. and Europe to form some sort of agreement that will allow travel to restart between the U.S. and Europe. Obviously, airlines are really suffering right now. IATA, which is the International Air Transportation Association, expects that airline traffic will fall 30% this year, but that's estimating that borders will reopen, that travel will be allowed to continue if we continue to see these border shutdowns.
Well, all seem to have lost that connection with Chelsea there. Well, we hope to get connected back to her as soon as we're ready with that. All right, stocks in Asia Pacific mostly declined today, but mainland Chinese stocks bucked the trend. Mainland Chinese stocks shared some earlier gains, but were still positive by the close. The Shanghai Composite rose 0.37% to close at 3,333.16, while the Shenzhen Composite was up 0.84% to 251.43. The Shenzhen component jumped 0.89%. In Hong Kong, the Hang Seng Index declined 0.48% with losses in tech and property names. Japan's Nikkei 225 lost 0.58%, while the Topix edged down 0.49%. Over in South Korea, the Kospi erased earlier gains to close flat. Australia's S&P ASX 200 lost 1.32%. All right, let's head to the UK, where equities were also on the back foot this morning, with the FTSE 100 losing around 0.5% after Trump's COVID-19 warning. Let's hear more from Juliana. Hello, Juliana. Good afternoon. Well, after yesterday's rally, things seem to be turning around today. What is shaping investor sentiment in the UK today? Is it about Trump's COVID-19 warning, or is it about the US-China trade war?
Good afternoon, Chimezie. Well, similar to what Chelsea was saying in Frankfurt, I think the sentiment today is definitely all around the potential trade war. Well, it is a trade war, isn't it? It's not really a potential. And Britain have been dragged into this spat. And not just because America and China are the two biggest economies, but it's because yesterday we had a visit from Mike Pompeo, the American Secretary of State, known to not mince his words on China. And he gave a joint press statement with his counterpart, the Foreign Secretary Dominic Raab. And during that statement, he was pretty, flying around some accusations about China's involvement with the World Health Organization. Again, with what Chelsea was saying in Frankfurt there about the potential of some of their embassies being closed down, both in Beijing and Washington. So that's really rattled the markets today. And again, Britain has been dragged in because, of course, last week we decided that we will no longer be using Huawei in our 5G infrastructure, which many believe is because of pressure from America. So at intraday, the FTSE All-Share is down 0.74%. The FTSE 100 is down 0.90%, and the FTSE 250 is down by 0.38%. In the currencies market, the pound is also down on the dollar by 0.42%, down on the euro by 0.80%, and down on the Japanese yen by 0.26%.
Now, the UK government has given Ford £500 million in loan guarantees to support export. What's UK's interest in giving an American automobile company this support?
Well, the interest is in protecting jobs. Ford in the UK, they have about 13,000 jobs here, mainly in an area in Dagenham, which is in Essex, and other small plants across the country. It's been almost 20 years since Ford started manufacturing cars here, but the exports is really keen to their entire firm. I believe that Britain export Ford components to about 15 different countries, and it brings in revenue for the UK of about £2.5 billion, and the government are really keen to make sure that that money is not lost, as of course, not only because of the pandemic, but because of Brexit, a lot of these manufacturers are looking elsewhere, and they want to ensure that Ford stay within their shores. So it's part of a £625 million package. £125 million is worth of loans, and £500 million is going to be backed by the UK engineering sector. They will back this loan, so if it does turn bad, then they are fully in support of this. And this is really to ensure that Ford can skill up some workers, so to make sure that the 13,000 strong workforce are fit enough and equipped enough to cope in this new post-digital era. They also want to make sure that their export activities can be scaled up because it is such an important part of the UK's export services. The Society of Manufacturers, car manufacturing, have warned already that car manufacturing is really at risk here in the UK. I believe last month they lost about 6,000 jobs. That's growing. The majority of people that work in car manufacturing in the UK are on furlough. We know that that furlough scheme is running out in October, and there are concerns that when it does run out, many people will be made redundant. So for the 13,000 staff in the UK, this is a great news story.
All right, Juliana, before I let you go, do you have your eyes on the gold market? Gold is at its peak now. Do you plan to sell or buy?
I did laugh when I read this question, Chimezie. I've got to say, if I am going to be buying or selling gold, I'll be doing it on your behalf, not mine. But I've got to say, this is a great time to sell gold because gold, as you said, I believe, is on a 7-year high in the UK. At the moment, it's worth $1,000.859. That was the last I checked at about lunchtime, which is up 0.8%. Of course, gold is a safe haven. So when there are worries in other markets, gold does particularly well. Stimulus packages from the EU is said to have spurred the rise, weakening US dollar. Trump won't like that, and the COVID-19 onslaught. So this is a great time to sell your gold, Chimezie. I don't have any, as you can see.
Well, I don't even have any, and I don't plan to sell, even if I do. Thank you very much, Juliana. All right, let's get back to Chelsea. Chelsea, yes, I was about to ask, a crucial deadline is approaching for millions of Americans who have lost their jobs. Unemployment payments that have kept many households afloat are set to expire within days. Will Congress extend the benefits?
It's really uncertain right now what's going to happen with these unemployment benefits in the U.S. So in the U.S., you have to remember there's not a very strong social safety net for people who lose their jobs. So whenever the coronavirus really began to spread in the United States and they started imposing these lockdowns, we saw tens of millions of people lose their jobs. And because of that, Congress did come in and sort of ramp up the benefits that people who are on unemployment can get. So they essentially gave everybody on an unemployment benefit $600 more a week. So that's really helped keep the economy from sort of combusting. There's obviously a lot of pressure on households when they aren't really bringing in any money. And this has helped to prevent, mass bankruptcies, mass defaults on loans, people not paying rent. This has really helped prevent all of that. But these benefits are set to expire at the end of July. But because of the way the unemployment benefit system works, many people will start to lose those benefits in the next several days. So that's obviously a huge risk for the U.S. economy. If they don't extend these benefits, many people will start having serious trouble paying their bills. And that will ripple through the economy in all sorts of ways. So congressional leaders, both Democrats and Republicans, are trying to come up with proposals right now. But there's obviously a very divided political environment. They don't seem to be on the same page about what sort of stimulus they should be enacting now, how much is needed. So this is obviously very necessary. Even Republicans, even the most conservative Republicans, do believe that there needs to be some sort of extension in these benefits, or else the economy will really have some difficulties. But obviously, there's going to be some very difficult negotiations ahead as they try to come together for some sort of agreement on how to keep these people from having really severe financial difficulties.
Let's just hope they extend this scheme. Thank you very much, Chelsea. All right, U.S. stock futures fell in early trading amid renewed U.S.-China tensions and ahead of major technology earnings from Microsoft and Tesla after the closing bell. Dow futures pointed to an opening loss of more than 175 points. Futures also implied a lower open for S&P 500, and of course Nasdaq looked a little bit up there in the green. Futures extended their losses in pre-market trading after the U.S. State Department abruptly ordered China to close its consulate in Houston. A few disappointing company earnings after the bell on Tuesday also weighed on investor sentiment. Earnings season continues on Wednesday with reports from Microsoft, Tesla, Chipotle Mexican Grill, CSX, and Las Vegas Sands. After the closing bell, all eyes will be on Tesla's earnings, which could make the company qualified to become an S&P 500 constituent. Biogen, Baker Hughes, and Nasdaq all report earnings before the bell. All right, we'll take a quick break, and when we come back, of course, there will be more on the show. To stay with us. The Monetary Policy Committee of the Central Bank of Nigeria earlier this week left its benchmark interest rates unchanged, and all other parameters were also left unchanged. Our central banks across the continent have adopted aggressive monetary policy initiatives in an attempt to boost liquidity in their economies, massively increasing the funds available to commercial banks and introducing debt repayment holidays. Well, this week and next, we'll see a number of African central banks, South Africa, Ghana, Kenya, even Angola, announce its rates decisions. Well, let's talk about all of these with a practice lead, a sub-Saharan African research at Docker Frontier in London, William Atwell. Hello, William. Thank you for joining us. Good afternoon.
Pleasure. Good afternoon to you too.
Now, the Central Bank of Nigeria left its benchmark interest rates unchanged at 12.5% at its July meeting. How, in your opinion, are international investors interpreting the move?
I think international investors weren't entirely surprised by this move. We know that inflation has been continuing to increase each month over the past several months. So there really wasn't much room to ease on interest rates. However, this, of course, is concerning international investors looking at the business environment, very aware the cost of credit is fairly high in Nigeria. And of course, businesses are really struggling with liquidity issues. So looking to perhaps gain loans to be able to see themselves through some of the depths of the coronavirus crisis. So I think they're obviously concerned that businesses are still going to find credit expensive, but not entirely surprised given that the Monetary Policy Committee doesn't really have much room given the inflationary environment. And of course, also given the pressure on the Naira right now. So they're watching the currency very carefully, of course, in light of the recent devaluation of the official rate, but looking to potential further devaluations going on into the next several months.
All right. Now, the South African Reserve Bank holds its next MPC meeting tomorrow. With inflation at its lowest point in 15 years, what are your expectations from the South African Reserve Bank?
So as we sort of flip to the other end of the continent, it's quite a different set of dynamics at play. Of course, South Africa, the economy also under tremendous pressure due to coronavirus and the global downturn, but their inflation really very low, and there's a lot of scope for the MPC to cut further. So we're expecting in Q3, whether it's tomorrow or whether it's later in the quarter, we do expect another cut, not a dramatic one, perhaps 25 basis points, which would take it down to 3.5%, which is the lowest, would be the lowest rate for well over a decade. So there's certainly scope to do that with inflation, of course, well below the Monetary Policy Committee's target inflation range. So that should provide some cushioning at least, and does, of course, dovetail and complement some of the monetary policy authorities and the government's initiatives to try and extend soft loans and additional credit for businesses and households, of course, as well, to see them through the coronavirus crisis.
Now, interest rate decisions are also coming up in Ghana, we have Kenya, and of course Angola in the next couple of days. Are there any consistent patterns in terms of region wide monetary policy you could comment on?
Yeah, so the pattern is really one of consistency and maintaining the status quo for the time being. There are a number of course, different drivers in each of these markets. They all have very different fundamentals. So in Kenya, inflation has begun to stabilize somewhat, but actually the initiatives that the monetary policy authorities there have taken are already having the effects they want. Credit growth has been fairly steady. And Kenya isn't seeing this kind of downturn that we're seeing in, say, Nigeria or South Africa. So the economic emergency isn't nearly as severe, and so less pressure to cut. So we're not expecting any cuts there. In Ghana and Angola, of course, they're also, like Nigeria, dealing with much higher inflation rates, very high inflation rates in the case of Angola. So really not much scope to cut more. And their currencies are, of course, under a lot of pressure as well. So we're not expecting interest rate cuts from those markets either. And of course, from an international business perspective, they're continuing to be concerned around access to credit, which I know has been a difficulty for companies in both of those markets and will really continue to be so into the next 6 months and ahead.
All right, we'll keep a tab on those monetary policy committee meetings coming up in a couple of days from now. Thank you very much for your time, William. William Artwell is the practice lead at Sub-Saharan Africa Research at Docker Frontier in London. All right, let's look at the global oil market space. Prices fell in early trade as industry data showed a bigger than expected inventory build in the United States, where climbing coronavirus cases may further dent fuel demand in the world's biggest oil consumer. In his first press briefing in months on the pandemic, U.S. President Donald Trump said the outbreak would probably get worse before it gets better, one of his first recent acknowledgements of the spread of the problem. Brent crude fell 35 cents to $43.97 a barrel, and U.S. West Texas Intermediate crude dropped 39 cents to $41.53. Oil prices climbed about $1 the previous day, reaching their highest since March 8. And gold jumped more than 1% in early trade today to its highest in nearly 9 years, driven by a weaker dollar and as expectations of more stimulus to revive pandemic-hit economies lifted the metal's appeal as an inflation hedge. Spot gold was up 0.8% at $1,856 per ounce after hitting its highest since September 2011 at $1,865 earlier in the session. U.S. gold futures rose 0.7% to $1,856. In other metals, silver continued to strengthen, rising 4.7% to $22.33 per ounce, its highest since October 2013. Palladium fell 1.1% to $2,133. And platinum lost 0.7% to $875. And with gold prices soaring on the heels of monetary stimulus, shares in producers of the metal are back in favor around the world. But investors are fretting about supply disruptions at South Africa's mines as a result of soaring COVID-19 infections. Non-residents sold a net 1.84 billion rand of the country's gold shares since the beginning of last week through Monday, even as Johannesburg index of gold miners climbed more than 9% to the highest on record. Virus infections in Africa's most industrialized economy climbed above 370,000 this week, making it the fifth worst affected country globally. And Ghana's fund managers are unable to access deposits tied up in failed banks will receive bonds directly from the government to boost liquidity. Money managers have been struggling to meet withdrawal requests from customers, cover their costs or make fresh investments. Their funds are locked up in second-tier lenders that lost their licenses after regulators last year clamped down on smaller savings and loans companies to strengthen the industry. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwago.